Welcome back to GeoScope. What began as a social media wildfire claims that China and India slapped a 300% tariff on McDonald's has spiraled far beyond fast food gossip. This isn't about Big Macs, it's about macroeconomics, supply chains, and national pride colliding in real time. Between 2024 and 2025, McDonald's became a symbol of how global trade tensions and online outrage can shake even the most powerful brands. But was there really a 300% tariff? Or are politicians, platforms, and perception fueling a fire that doesn't exist? 300% tariffs or 0% truth, what China and India actually did. Despite viral headlines, neither China nor India imposed a 300% tariff on US fast food imports. Global chains like McDonald's already rely on localized sourcing, from packaging to produce, leaving little room for imported items to even be taxed. What did change is the broader trade battlefield. In April 2025, China raised certain retaliatory tariffs on US goods up to 125%. Then in October, Washington hit back, threatening an additional 100% tariff on Chinese imports, along with tighter export controls on US software. These aren't burger taxes, they're infrastructure pressures. They raise costs for everything behind the counter: restaurant equipment, payment systems, and logistics. Meanwhile, India's pressure came from people, not policy. After US tariff hikes on Indian exports, social media campaigns calling to boycott American brands went viral, cutting into foot traffic without a single official tariff. The takeaway: the 300% tariff never existed. The real strain comes from broader trade tensions, export restrictions, and nationalist consumer sentiment. Two McDonald's demand signals: value revival and strategic retrenchment. From 2024 to 2025, McDonald's has faced a volatile demand cycle. A 1% global sales decline marked its weakest performance since the pandemic, with lower-income consumers pulling back on spending. US demand remained soft, though Japan and the Middle East helped stabilize overall results. To counter slowing traffic, the chain doubled down on value, introducing $5 meal bundles, price rollbacks, and loyalty-driven promotions. Two strategic pivots defined this recovery: the return of monopoly, after nearly a decade, to boost engagement and app usage; the closure of its separate beverage concept, folding top-performing drinks back into the main menu to cut costs. These efficiency moves helped, but analysts warn discounts can drive traffic, not resilience. In Asia, higher input and equipment costs driven by tariffs continue to pressure margins, regardless of marketing success. India and China at a crossroads: pride, price, and the boycott effect. Both India and China are testing the limits of global fast food models, but for different reasons. In India, the post-pandemic dining boom has cooled. Consumers are cutting back, trading down, and turning to nationalist calls to support domestic brands. Boycotts fueled by emotion are now shaping business outcomes. In China, the challenge is deeper, confidence is shaky, and geopolitics has become an operational cost. New, rare earth export rules and tech restrictions have inflated prices for imported machinery and software, essential for any major restaurant chain. Even with strong local sourcing, global brands can't escape higher capex and tightening margins. The markets that survive will be the ones that embrace localization, digital precision, and targeted pricing, not those that chase volume through endless discounts. 4. Trade war crossfire, tariff threats, rare earth rules, and inflation risks. Stepping back from the rumor mill, one thing is clear: this isn't a fast food story, it's a frontline trade story. The looming 100% US tariff on Chinese imports acts like a loaded chamber. Whether it fires or fizzles, the impact ripples across every sector, from autos to restaurants. McDonald's may source beef and bread locally, but its backbone, refrigeration units, POS tablets, kitchen tech, is deeply tied to Chinese manufacturing. When those links weaken, every outlet feels it. Markets have already shown their verdict. Equities dipped when tariff threats hit headlines. Rising hardware costs, delayed shipments, and tighter financing terms now squeeze expansion plans across Asia. Shifting supply chains away from China won't happen overnight. Recertifying vendors and equipment takes time, potentially stalling growth well into 2026. 5 scenarios ahead: rumor versus reality in the golden arches. McDonald's future now depends on how trade policy unfolds. Best case, tensions ease. The US shelves its 100% tariff threat, China limits restrictions, and costs stabilize. McDonald's leans on value meals and monopoly to regain global momentum. Tough case, the tariff takes effect. Export controls tighten, inflating equipment and capex costs. Expansion slows, formats shrink, and paybacks stretch. Middle ground, no new shocks, but persistent consumer caution. McDonald's focuses on loyalty apps, day-part bundles, and local promotions. Steady, not spectacular. Whatever happens, one fact stands. There is no 300% burger tariff. The real conflict is between policy and purchasing power, not rumor and rhetoric. Final verdict: signal versus noise in a geopolitical market. McDonald's isn't leaving Asia, but its strategy is shifting. The viral 300% tariff story is fake, yet the real pressures are very real. Tariff brinkmanship, rare earth restrictions, price-sensitive consumers. It's counterpunch, value menus, nostalgia-driven campaigns, and ruthless localization. If tensions ease, partner-led markets like Japan and the Middle East will keep the brand growing. If not, higher capex and slower expansion will reshape its entire model by 2026. Because at the end of the day, this isn't about burgers, it's about how global brands adapt faster than geopolitics can shift. Before we close, tell us, are boycotts and public sentiment more dangerous than tariffs? Can value menus fight inflation when costs rise behind the scenes? And is localization the real shield against global trade wars?